Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at the Exchange ETF conference. Joining me for this segment, we have Alex Morris, who's the President and Chief Investment Officer of FM Investment. We're going to talk about fixed income investing. Alex, it's great to have you with us. Welcome to Trade Talks.
Thanks.
Let's talk about, looking at increased income streams and dividends. It seems to be that investors are focused on those companies where they're strong, good balance sheets, and they pay those dividends.
Well, they have been, and we're excited to see that. We're glad to see a lot of interest coming back to the market. In the fixed income side of the world, really excited the yield curve has stayed where it needed to be for us. And when we were chatting, when we launched some of our ETFs, that was almost $500 million ago in just under 6 months. So it's been a really exciting opportunity set. And I think investors are going to be really focused on income for the next little while.
So what about dividend and tracking the underlying coupon?
So the coupon rates have been going up, but it's been taking a while for that to really sit and sift into the market. Certainly the treasury market is super responsive. The government can issue and does regularly reset all of their rates. But in the corporate world, folks have been slower. I think we're going to see much more debt come out this year that'll be much more useful in that capacity. But recently, folks have sat out. I mean, if we look at current corporate issuances, it's almost all under a year, which we think is really the market's way of saying maybe this too will pass, but the Fed has made very clear that's not going to be the case.
Right, it's so interesting. It feels as if the market wants the Fed to do something, and Powell's been very clear about telegraphing the message, and they're not going to shift policy and make the mistake that they did in the 70s by doing it too quickly, and the market just seems to be so disjointed from the messaging.
That's right, the market seems to be rewarded every now and again. If I look at the cadence of how the meetings have gone, the messages are pretty clear. They're relatively dovish. Then there's questioning, and Chairman Powell comes out, and it's 20 minutes of slam poetry of why this is wrong, and equities should go down, and no one should be doing this. But then the Fed governors come back out, they walk it back, and the market sort of puts on its rose-colored glasses again. But the message is very clear. This may be 6%, it certainly will be in the 5s, and it will be in the 5s for some time. And ultimately the bond market needs to get used to that and react to that.
Let's talk about infrastructure for a bit here. It seems as if transaction costs, the ability to move from the short end to the long end, it's so much more efficient these days.
Absolutely, and we're trying to make it even more efficient.
Right, so tell us about that.
So we currently have 4 single treasury ETFs out. We want to finish out the yield curve in the course of this quarter, which we will, which will give folks the ability to, in one click or in one rebalance, move anywhere on the curve they want, or even go short if they want to play a flattener or a steepener trade.
And that's because of the ETF wrapper, making it more efficient for fixed income portfolios. How has that changed as a money manager, being able to do this within an ETF?
For us, it's great. I mean, we built it selfishly for ourselves. Mm-hmm. We trade bonds all day long, but it's very hard to get great and simple execution across all of our clients. We want all of our clients to benefit from the benefits all of our largest clients do. And the ETF makes that universal and simple.
Do you see in the fixed income space perhaps more digitization or modernizing the markets in fixed income?
I hope so. Right. It's a big market. Everyone still trades on QSIPs, right? You've got 9 characters that no one knows where they came from, so we've got a long way to go. It's a pretty low bar. Certainly the ETFs are going to push us there. We're going to see more innovation, which bonds have not been terribly innovated. They haven't need to be. But ETFs give bond managers now an opportunity to take really complicated ideas and make them universally accessible. Right. And that, I hope, is the start of a much bigger trend that we want to be part of.
All right, well, great to meet with you. Thanks so much for the insight, Alex, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.